Hi guys, this is Dan from the Investment ABC, and in this video I want to discuss why I think we will most likely retest the lows of March again this year. The Dow Jones rallied back up approximately 30% from its lows despite a worsening economy and the highest unemployment numbers since the Great Depression, and the Nasdaq almost recovered all of its losses. As a veteran in the markets, I know that the stock markets are rarely go hand in hand with the fundamentals of the economy. They are more of a leading indicator for the health of the economy, but currently the stock market is priced for perfection and there is no room for the slightest thing to go wrong. Right now, many investors are believing in two things. A, the current health crisis we are facing now will be over soon, and when it ends, the economy will recover quickly back to pre-crisis levels, and B, the Fed has the markets back and will not let it fail. In my opinion, both of these reasons are wrong, and the market will start to figure it out very soon. The chances of a second outbreak similar to what we can see in China and South Korea right now is very real, and the markets did not factor this in yet. On top of that, even if the economies are 100% open again, we might see a small bump in recovery from all these people who wanted to buy something but did not have the chance because of the lockdown. But it will be only temporary in my opinion. After that, people will act way more cautious with spending than before. Most people won't risk their own lives and those they love unnecessary just to go out and consume something. Consumers will still avoid to be in crowds as much as possible. That includes flights, hotel trips, restaurants, and other large gatherings. Many of these entities will make a huge loss when they are just running on 30 to 50% of capacity and need to close their businesses soon if things don't get better very quickly. In this globalized world, businesses are interconnected. One business is a data to another one, and they are the foundation for employment and economic activity. After reopening the economy, chances for disappointments are very high in my opinion, and the market did not factor this in either yet. Me and my wife, for example, we bought a thermomixer to make cooking at home easy and as fun as possible because we don't want to eat that much outside anymore. With the help of that device, even I or my children can cook a quick meal which tastes way better than in most restaurants. The device is quite expensive, but the value you add to your life is worth the money, and you save over time by cooking yourself fresh food. This is just one example. Another one is cutting your hair yourself or let a family member do it for you to avoid to go to the barber. No one knows 100% how many people changed their spending habits forever. Governments and central banks are trying to prevent the stock markets to crash by flooding the markets with unlimited amounts of liquidity and stimulus checks. But they can't force consumers to spend this money. The only way they could boost confidence in spending is that the government would announce permanent stimulus checks, but that would just open the Pandora's box of higher inflation and a decrease in productivity. Central banks and governments are desperately holding the dying system together, and the last card they have, and which they will most likely play in the near future, is the negative interest rates cards. Negative interest rates is the last tool the Fed will use, but they will play this card only when the markets take another hit in my opinion. Therefore, I wouldn't bet my house on the Fed pushing the stock market higher than the levels we're seeing currently. On the contrary, in my opinion, the Fed lured more and more retail investors into the market than ever before. If you look at the Nasdaq, it feels like the dot-com bubble 2.0. Just look at valuations of companies like Shopify, Twilio or Square for example, and tell me we're not in a bubble right now. Even Elon Musk felt bad for Tesla investors and tweeted that he thinks Tesla shares are just overvalued currently. But investors seem not to care. This is the classic setup of a bear market rally, disregarding all warning signs and FOMOing into the market. Very soon the Fed will reduce the support for the markets, and together with other factors like a reduction of stock buybacks, disastrous earning results, and the distribution of shares from the prudent investors like Buffett to the buy the dip crowd, the market will suddenly start to crash again in my opinion. After the markets have dropped far enough, the Fed will come out with their final bazooka negative interest rates and save the markets again. I am not the only one who thinks like that, but Warren Buffett may be also thinking that negative interest rates are not that far away. Buffett has reduced his Goldman Sachs position by a whopping 84%. Moreover, he also sold shares in US Bancorp and JP Morgan. So it seems like Buffett is very bearish for the US banks and the overall economy and is throwing his own rules to hold stocks forever overboard. It is no surprise to me because negative interest rates would reduce the bank's profitability substantially. Don't look at what the big boys say, observe what they do. We have to see when exactly the Fed will introduce negative interest rates, but in my opinion, it will be sometime by the end of this year most likely. If we have a look at the chart of risk assets like the Dow Jones and also Bitcoin, we can observe that in both asset classes the rally lost momentum, and it is going to be very interesting to see if prices are rolling over in the next 2 weeks. In the Dow Jones, we broke down of this rising wedge here, but the breakdown wasn't steep but more a sideways movement which is getting lower highs and lower lows, similar to a dizzy boxer. And if we have a look at the chart of Bitcoin, we can see that it had a massive run up similar to the Dow Jones from around under 4,000 US dollar to above 10,000 US dollar before topping out. Currently, Bitcoin is at the make or break point in my opinion. The strength of Bitcoin is that it is enjoying both the speculative property and the safe haven property at the same time in this moment. Many investors buy BTC next to gold as a hedge against an economic collapse or high inflation rates, while other people are just speculating that the prices keeps going up. We will see if Bitcoin can keep up the momentum and decouple from the stock markets and follow gold, or if it is rolling over together with the traditional markets. It is going to be very interesting whatever it is doing. I will observe what happens in the markets and may try to find a good entry for a put option when the time is right. Furthermore, I have sold all my shares, even my core holdings in the past week, and will position myself defensively to profit if there is another leg down. In my opinion, it is the best time to analyze companies and create a watch list and exactly know at what price you want to enter. This is one thing you have to do right now, guys. If you like this video, hit the like button to support the channel, subscribe if you haven't, and comment if you think the Fed will let the markets fall or not. Bye and see you in the next one.